One very simple argument from opening government, that this balances the interests of startups and their shareholders such that you have more startups, better investments in these startups, and you better protect shareholders rather than a world in which they hold the debt from these startups. What do we think the rise of debt financing looks like? We think it's broadly two things. First, it's issuing bonds as a company. So you enter the bond market where you're competing with government bonds as well as the bonds issued by other startups. But secondly, as I think the clarification noted, there are a variety of other financial instruments that you can rely on in order to engage in debt financing. So bank loans, for example, negotiated between these startups and large banks. Importantly, this is necessary if you cannot find sufficient demand for your bonds as a startup in the bond market. So you need to resort to this as a necessary measure. If, for example, your bonds do not have sufficient lucrativeness relative to government bonds, maybe they can't show the same kind of stability, or maybe the kinds of interest rates that you find in the bond market are far too high for the risk tolerance of these startups. So there are a variety of reasons to suggest that issuing bonds is not the only way that you can do this. Second, why do we think that the rise of debt financing has occurred? We just want to point out that this is not the norm among many startups, it's very unclear why startups themselves would want to do this unless they already had the backing of very promising corporate financiers, for example, those that begin in incubators, rather than startups that start from like people's garages based on their ideas. So it's really a very small number of startups that are making this the industry norm because they have strong corporate backers already that have invested significantly into the shares that are less willing to have their shares diluted. So these are like large startups funded by incubators rather than the majority. Problem, when this becomes the norm and issuing debt becomes the norm for raising money as a startup, it becomes more difficult for other smaller startups to do this as well. What do we think raising equity looks like? First, there's a private market for equity in a moment. So you have many like private credit institutions that will buy your shares. But secondly, we're more than perfectly happy to support a world in which many of these startups IPO far earlier, as we will prove in the argument. We think this is a good thing. Go.
Just to be clear, you aren't claiming these two things are mutually exclusive, right? You can take on debt and sell equity, and the two things don't affect each other operationally at all. Well, you can have both.
Well, they're mutually exclusive because you're far willing to hold debt in a company where the shares have been significantly diluted between a very large number of people, as I will prove. First argument, that this balances the incentives of startups and shareholders. The first claim that I want to prove is that you are far less willing to found startups in a world in which issuing debt is the norm. Why does this become the industry norm? Even if, as I pointed out in setup, it's a small number of startups that are leading this charge. It is because you put yourself at a massive competitive disadvantage as a startup that is not issuing debt if you choose to issue shares. The basic reason for this is you lose profits that could be reinvested in the form of dividend payments to shareholders, and you lose significant controlling interest over your own company because many of these shares, in order to like get the most lucrative share price, need to come with some kind of voting and controlling interest because shareholders want control over their investment. So there are many short-term costs associated with this. These costs don't exist when you issue debt. Government bonds are long-term financial instruments. Debt repayments as well as the interest and the principal only happen in the long run. The second reason is capital and agility also decreases quite significantly. The more shareholders that you have, you need to share information with a large group of people. You need to include them in decision making if they hold voting shares. Thirdly, shareholder expectations. Given that these startups already have some shareholders, in a world in which you now see that there are other startups that are issuing debt, we think that the willingness of shareholders to do things like dilute their own shares as a means to raise capital is far, far lower, which is why we regret this trend. Now, despite this, there are strong reasons for very promising startups that have good ideas, that are socially utile, that could make a lot of people a lot of money to not want to issue debt. Two basic reasons. First, you know that you will have to pay back this debt in the future, the principal as well as an interest. So you need to become a profit-making company. Problem, there are many difficulties associated with becoming a profit-making company when you begin as a startup rather than selling your idea to an already established company. This risk and uncertainty exists at multiple levels. You don't know whether you will, for example, have a promising idea that is actually, maybe it's like speculative and you don't know whether this will succeed. Maybe it's actually a very good idea and there's lots of adoption by consumers. Secondly, there's a time lag, right? Like there are many stages of development that an idea needs to go through in order to become a finished product. And we think even though companies might say that they have a finished product, for example, Uber had the app since the beginning, it's very difficult to get it to the point of profitability because you need adoption by consumers, adoption by producers. Notice that many of these apps are seeking to like upend existing industries. So it's very difficult to know whether this will succeed. No, thank you. What is the impact of this? Fewer people are willing to found startups. They sell their idea to larger corporations, and these larger corporations often have vested interests not to act on these ideas. Imagine a world in which the idea for Uber is sold to like a taxi cab company that obviously doesn't want to do this because they don't want to upend the existing system that is already highly profitable for them and their shareholders. So for this reason, fewer startups are founded. Second, why do we protect shareholder interests on our side of the house? Well, startups, even if they are debt financed, could still fail, right? There are many reasons to believe that this is the case. As I previously analyzed, risk and uncertainty is very high in the market for startups. We think that a world in which you hold shares in these companies is a world in which you are more able to compensate this loss for two reasons. First, the fact that shares give you somewhat of a controlling interest is a good thing because your expectations of when this company will begin to make a loss are far higher because you have access to the information, the financials of this company, as opposed to when you're merely a debt holder in this, you hold the debt and they have an obligation to pay that back for you. But if this company goes bankrupt, no thank you. We don't think that you can act on this. For example, bankrupt companies often have their liabilities waived. So, for this reason, we think shareholders can form expectations of when these companies will perform poorly. They can try to guide the company in a different direction through their voting shares, or at the very least they can liquidate their shares and use their controlling interest to sell off, for example, the assets of this company, which we think is a good thing because it means that they can get back some of their money. Now, I know what you're thinking, but why would you buy shares in a failing company? The problem is markets are not perfect, right? You lack information in many cases. So there are many startups that had very promising ideas that they were able to sell to corporate investors. Think of Theranos, for example, that ended up being unprofitable. So we think issuing shares is the better way to hedge for this risk. Secondly, I just want to point out there are also some perverse incentives to buy the shares in startups, even if you don't believe the final product will be profitable. For example, you engage in speculation. There's a massive secondary market for shares. Many hedge funds are able to raise significant money by jumping on this hype train. So for that reason, we think a world in which more shares are issued is a world in which more shareholders are protected and more startups are founded. Thirdly, the comparative and unique benefits of IPOing earlier. We just think IPOing earlier is generally a good thing. First, we concede that there's probably a ceiling on our side of the house to the extent to which you can get access to a private share market. So, you IPO far earlier. What are the benefits of this? First, financial transparency. Public companies need to release more of their information. Secondly, access to good investments. We just think a world in which more pension funds, more public credit that most people have their savings in are able to invest in better startups is a good thing. Third, more working capital means that these startups can actually act on their ideas even if they lose some control. For those reasons, opening government.
Thank you, Prime Minister, for that excellent speech. And I please call upon the Leader of the Opposition to begin our hearing.
Oxford always sounds like they're reading from a matter file, and I honestly think this debate was no different, right? There was just zero analysis on why the rise is specifically to be opposed. It's just like sort of a debate about whether or not taking debt is good or bad in a vacuum. Probably a lot of their harm still manifests absent the rise. The bigger actors, the more important ones, the more relevant ones, probably still do take out debt. It is about the specific rise and what implications that has for the round. O is going to take that into consideration in a far clearer way. Let's start off by talking about why your investments are likely going to be worse for startups in general. But broadly speaking, I think this debate should be adjudicated on what is best for startups and not what is best for investors. Insofar as like startups probably just, even if they don't pan out and even if they do fail, just genuinely do further things that are good for society. Like most startups that fail, right, in the pharmaceutical industry, for instance, just tend to be salvaged. So whatever technology they do develop just tend to be swallowed up by larger actors that are able to later on develop on it. Even if this means that, a few Wall Street investors, lose some money, it still leads to advancement, it still leads to innovation. Broadly speaking, probably the startups are more important than those investors. I'd also just posit, this is about big startups. They are already at that stage, whatever, C stage, whatever the fuck you called it, which means that like probably the sorts of people that are investing in it isn't, the average person. It probably is just, richer actors because these deals just tend to be more exclusive. Sure.
Do you agree with opening government's definition that this isn't just about issuing debt, but it's also borrowing? Do you think this is a fair definition?
Laura will tell you, I don't fucking know. Awesome. Firstly, deals that you get where you take on shareholders are likely going to come with more strings attached compared to when you take on debt. Why? Well, simple. When you make a deal with equity, right, you have these tech guys, you make deals with them, they're able to convince you of things that just tend to be quite intangible. That is to say, when you take on a shareholder, they come on with the promises of doing things like providing expertise, teaching your company how to work, providing you with connections to the other things that they've invested in. These are things that are oftentimes quite hard to tangibly put into contracts, which means it is easy to backtrack on them, right? So these sorts of deals that you get are likely going to be deals where people are strong-armed into them in many instances, and they tend to just be bad for the startup to begin with. But you might think that, but you as an investor probably want these startups to succeed, which means you have good incentives to not do such things. 3 reasons as to why sometimes you just don't. 1, like hostile takeovers do occur. Secondly, likely you want to some instances, sell off your shareholders, which means if you do things that are like bad for the company's long term, but short term it makes your shares go up, you can probably sell that off and make that somebody else's problem, which means you don't always have the long-term interests of the corporation in mind. But thirdly, you also just like have other actors that can be successful in certain instances. So if you are a person with a lot of money and you're investing in multiple different startups, if one of them suddenly booms, you just might snatch your money from other ones that are viewed to be less important to you and pump it all into that one, which might come at the expense of that other one, which maybe isn't good for the employees there, but it's good for you because that's how you can squeeze out most money. Which means oftentimes there tends to just be pernicious incentives where you get bad deals and you push corporations into taking on bad deals and bad shareholders that don't have their best interests at heart. The comparative is one that is just far, far clearer. That is to say, the amount of debt you're taking, the amount of interest you have on that debt, the period in which you have to pay it, and the consequences of not paying it, right? That is to say, what you're leveraging towards getting that debt or whatever it is. This just means that the likelihood that pernicious incentives sneak in is just gone. Like, it's tangible. You are making a decision. You're making a deal with a contract with a bank. They're not going to like dupe you in any way, shape, or form. I can't even imagine what that would look like. I can think of 40 examples for the other, as I've listed to you previously. So I think the comparative is clear on this one. But secondly, shareholders tend to just do things like restrict the autonomy of the startups that they're investing in. 1, they can threaten by pulling out. That is to say, shares aren't always set in stone. You can pull out your investments and pump them into other things, which means you can oftentimes strong-arm corporations into doing things that may be in the interest of you as a shareholder. Maybe you don't want them to enter a certain sector where you have money invested and you don't want that to get more competitive or whatever it is, right? So you can threaten that corporation to do things that are beneficial for you, but not the startup at large. Secondly, they can do bureaucracy and whatnot. Shareholders can do things like halt votes. They can call votes when they're not necessary. They can make decision-making slower. They can make the company less mobile when it is beneficial for their own selfish interests, right? Which just means that you restrict the autonomy of that startup that they're investing in. But thirdly, oftentimes they want to do things like deter other people from investing in the startups that they already have. Once you take on more equity and you take on more shareholders, the existing shareholders obviously become a smaller part of that corporation, which means they lose power. So oftentimes, even if you're able to find more equity and more capital from other actors that do have your best interest, that can provide expertise, it's not certain that the shareholders that you've already taken on are likely to allow that to happen, insofar as it might hurt their own strategy with what they want and what vision they have with your company. We have more of that autonomy on our side of the house when you just take that and you don't restrict yourself from collaborating with different people. But thirdly, surviving long, even if it means that the corporation is going to crash, is probably also just good. That is to say, investors tend to just pull out when there are short-term issues with the corporation. That doesn't mean that corporation is going to fucking die, but if you take on debt and like live on in the future, like this just is possible and it is something that you can do. But 4, I think the market probably also does just solve for a lot of dumb debt-taking decisions. That is to say, when you take on debt, you probably have interest in like not taking on too much debt and doing bad things. And the startups that do things like take on too much debt probably do disappear in the long run, and other people can learn from that. Like, I think the market eventually does just solve for this, and we do end up getting these startups that can responsibly choose to take on debt when it is beneficial for them. I don't think the ones that just take on debt with bad terms and whatnot are likely going to thrive into the future, which means they're not majorly relevant for the debate. But additionally, and this is crucial, the rise of taking debt incentivizes better behavior with the way in which you engage with equity. That is to say, you in the status quo where you have a rise of debt taking now just have more bargaining power, because you can either take on shareholders and take on other people to invest in your company, but due to the rise in debt taking, it is just more normalized and more likely that you're going to take on debt, which means you have more of a bargaining chip, right? You can tell them that either I'm going to take your money as a shareholder or I'm just going to take on debt. That's what that rise does, which means you're more likely to get favorable terms. You're more likely to maintain autonomy over your company. You're less likely to get pernicious shareholders insofar as you actually have something you can bargain against them with in those deals where you decide whether or not you should take your shareholders or whether or not you should take on debt. So I think on net, the debt taking that exists on our side of the house just gets better when you have that rise, and the way in which you collaborate with shareholders gets better also. Sure.
Most of your case relies on the egregious lie that you can sell equity in a VC. There is no secondary market for this form of equity.
Whatever that fucking means. Let's talk about what my case then broadly means. A, you're likely going to maintain control of your corporation, right? Because you don't have shareholders, you don't have other people, you just simply put half the debt, which is probably good. Why? Because this is like a relatively decently doing startup. It's already reached that milestone where it's worth a lot of money, which means probably the people who have worked with that startup just know what they're doing. They're likely going to make good decisions for that startup. They probably don't need shareholders to make decisions for them to be successful in the long run. But I'd also note, your reputation is at stake as somebody who owns that company, equity, right? If you're the person who owns a startup and you take on debt and you maintain control, you understand that if this startup fails, nobody's going to give you money into the future. You're not going to be able to do other startups. You probably have good incentives to treat your corporation well and to be responsible with the debt and to do good things with it in the future. Shareholders, however, can oftentimes have pernicious incentives. They can, want to salvage you for parts. They can want to take out like junk bonds or whatever it is in your name to try to sell you off in like a bloated scheme or whatever it is. Probably the people who own these startups and the people who started these startups care about them much more than that, and probably they make good decisions for the startup at large. Proud to oppose.
Thank you, Leader of Opposition, for that excellent speech. Can I please call on Deepak to close on Fuji? Here, here.
Cool. Ready? I want to be very clear about what the frame of this debate is coming from opening government. If some startups engage in debt financing on our side of the house, we think it is fine as long as they are the startups that can pay back these debts, and then if they issue that is perfectly okay. Our harm applies when the rise of debt means that companies, even if they can't actually pay back this debt or are very uncertain of whether or not they can pay back this debt, are compelled to do so in order to be competitive. And the reason why this is true is because Chanidu tells you why, right? At the point where this becomes a norm for the vast majority of companies and industries, that is when there are certain competitive advantages. For example, the fact that capital agility decreases if you don't do this, the fact that you put yourself at a massive disadvantage insofar as you give up some control when you issue equity to the shareholders, which doesn't exist when you give up debt, right? Therefore, as more and more companies then decide to issue debt as a way of financing, that is when more startups, even if they are themselves not sure, do this more. I think Chanidu proves this absent responses from opposition. I think this is the place where our harms accrue. With that being said then, two simple parts of the speech. First, first on direct responses, I'll prove why opening opposition largely falls out. But second, I will prove why on their own metric, which is on which side are there more startups that do better things for society, we'll give you a lot of independent analysis that wins independent of the clash with opening opposition. So, broadly, opening opposition gives us two ideas. The first thing they tell us is investors often have bad incentives when they invest in startups. There are two things to say here. One, I think it is very counterintuitive for why the vast majority of investors have bad incentives to pump and dump, right? It seems far more likely that if you are a venture capitalist or whatever, investing in, and buying up equity, then you actually want to make money, right? Insofar as only if the startup actually is successful do you actually recoup your money. So maybe in some cases you can pump and dump, but if most startups are going to be successful, it is far better to actually let them be successful, because pumping and dumping is inherently oftentimes very speculative, right? You don't know the extent to which you're going to be able to recoup the losses from your next investment, whereas if the startup is successful, you will get a return on your money. So most investors probably don't act in the bad way that they characterize. But second, in many cases, if you're the sort of venture capital firm that is very known for pumping and dumping, it is probably true that in a competitive market where there are many private equity firms buying up equity, you just get a very bad reputation for making your startups go under. So people are less willing to offer you shares in their startups before they IPO, right? And therefore you lose on the competitive edge to your better investors. I think these are very strong reasons for why it is very unlikely that the characterization of investors on opening opposition is actually true. But the second thing they say then is this idea of how there's only one investor, that they have an incentive to prevent other investment firms from being able to break into the same market as the startups. They will do bad things to the startups so that other investors can't buy up equity in the same startup. Three reasons why this is not true. One, in many cases, pumping and dumping only actually works if there is a secondary market for you to resell these shares, right? Insofar as this does not exist in cases where it's a singular venture capital firm owning a startup, this is just not true. But second, if this is actually about cases where there are multiple investors in the same startup, then this is probably a case where startups IPO faster, right? And we flip this then when Chanidu gives you reasons for why IPOing faster is good. Just two things to say here, right? When you have many investors, this is when it is far harder for a singular investor to run the firm into the ground, even if they have bad incentives. But two, there are some independent benefits of IPOing faster. A, the fact that in addition to venture capital and private equity firms who maybe in some minority of cases want to behave in bad ways, you get far more secure investments, right? Things like pension funds and other forms of investment funds beyond just venture capital. But B, the fact that there's now greater financial transparency because these startups actually have to disclose far more financial information to prospective shareholders means it's far easier for prospective shareholders to gauge whether or not this is actually going to be successful successful startup or not, or whether or not it's a good idea to invest in them, right? And critically, this is the one part of this debate where shareholder benefits actually matter, because the people who are investing in these better kinds of investment funds after startups IPO aren't just super rich venture capitalist fat cats. It's often like regular ass mutual funds, pension funds, other sorts of investment funds, which take regular people's money and then invest them to sort of build up savings and so on and so forth. So in those cases, we think the investment funds having more information and more startups IPOing and giving this information is actually a very, very good thing. So if there is a clash of investor benefits, there is actually a slight margin and we're winning on that margin. But the bigger margin then is on what's good for startups, right? So we accept opening opposition's frame that startups often do very good things. There are two ideas that Chanidu gives you, which I'm going to weigh and explain why they are more important, even if you as a panel believe most of what opening opposition says in that argumentation. Before that, closing.
Your case appears contradictory. You say they take on debt, not equity, because it's advantage for them, but then you say some startups can't raise debt. Surely those just raise equity. This seems like a non-issue.
No, right? So the issue is when more and more startups take on debt, right? And given that in the short term there are certain benefits to running the startup as a company and decision making, as opposed to long-term financing, there are startups that will be compelled to do this, right? But also one of Chanidu's arguments is not contingent on this, and I'll explain in a way why that's very important. So, what are the two arguments that Chanidu gives you which are left untouched by opening opposition? The first idea is just that there are many startups who are unsure of whether or not they will be able to actually make back a profit, and they will just be less likely to actually start up, so to speak, in the first way, right? Because in many cases you're very unsure of whether your idea is actually good. In many cases it's very unclear to you whether or not you will be able to get back your economies of scale or actually get returns on your idea, even if you're able to sell it. And in those cases this is very bad, because at the point where now the norm is where there's a greater norm of issuing debt and people are less, and there's less actors willing to buy up your equity, that is when these startups find it harder to raise amounts of money and therefore grow. This is bad for two reasons. This is bad for two reasons. The first is just that there are less ideas now, right? So there are less startups that initially start up in the first place. There are startup founders who are less likely to go ahead and take that risk and form the startup in the first place. And this is very bad, because we agree that startups are good, but most startups fail, right? And there's a huge amount of risk and huge amount of uncertainty in which startups actually succeed. So the best metric for making sure that the most successful startups and the best ideas actually happen is making sure that the broader pool of startups is far, far greater. Therefore, it is better for us when more people found startups in the first place. But second, we think that when there are less startups, there is less money floating around. That is when the total number, that is when in the pre-IPO stage, the amount of ownership is far more concentrated in fewer venture capital and private equity firms, just because there are less startups, so the total amount of market is lesser, and it's easier for some big firms to control more of the startup market. This is when we flip opening opposition and say in cases where these venture capital firms actually want to behave badly, that is when the harms of them behaving badly and wanting to run startups into the ground accrue far, far worse on their side. The second argument that Chanidu makes, which is again unresponded to by opening opposition, is the very simple idea that shareholders often like equity a lot more than debt, and this is simply because one, it is far easier for you to form expectations of how the company will operate when you are able to get a degree of voting rights and get more information when you're actually holding shares. But two, in the worst case, you know that if the company goes insolvent, you can still liquidate the shares, and maybe you make a loss, but you get some money back, right? On their side, if the company goes bankrupt, then it's they can't pay you back the debt, right? And this is a problem, because on their side of the house, people who want to invest in startups are far less likely to invest in startups that see as slightly riskier, maybe having big social benefit, but less immediate quarterly returns, right? And so it is actually on their side of the house where there's less investment, where investors are far more bearish on the kinds of startups they invest into, so they get less money flow. And this is another reason why there are less startups on their side of the house, and the startups that do have less means of financing themselves. For all of these reasons, opening government.
Thank you, Deputy Prime Minister, for that excellent speech. Can I please go with the deal with your here.
You ready? It's 3 relatively simple pushes we give you on opening opposition. Number 1, more innovation is always good. Even in the short run, this doesn't mean that you're incredibly profitable within 5 years. There's still gains to be made from this, whether it outweighs potential harms for shareholders, whatever. I actually don't give a fuck if rich people lose a little bit of money. Insofar, we get significantly more investments, which we'll prove more carefully in this speech. Second push, and I'll note opening government agrees with this. Yay, innovation, nice. They do run a case, however, on shareholder value, so I don't think they actually prove innovation on their side of the house. Interesting dynamic there. Second push we give you is autonomy of the startups and why it's just significantly better when you limit the capacity for shareholders to access you and exercise this knowledge over you. They are dependent on you having the capacity for this. I'll point that out in the following ways, but I think Darin does a good job at explaining why it is that they're likely incapable or have bad incentives. But note the PM already concedes that some of them actually just fucking have perverse incentives. You can check your notes on that they actually say that. But thirdly, we explain that they're probably bad for lots of reasons. But the first thing that Darin sets up is just the comparative and the types of contracts that you enter. That they're always going to be vague on your side. When you enter the negotiation table, they always ask you for a little more equity because they know then. No, you just had 14 minutes. They ask you for a little more equity because they then think that you can trade that off with the slightly more knowledge they have. They'll take you to slightly more investor dinners. All of these types of things that are just incredibly vague compared to the types of things you put into contracts when you're making debts or loans or whatever you want to call it on closing. I don't give a fuck. I'm ESL. These are the same things to me, Max. That answers the first PY you gave Darin. Cool. So, yeah. So, just why it's significantly clearer. No, thank you. Why it's significantly clearer for you on our side of the house, and why you're less likely going to be strong at because the contracts are more clear, less exploitative, blah blah blah. But then, secondly, I'll note that there's just a difference in the way that we characterize shareholders. Are they going to be short run, incentivized, or are they going to be there for the long run? More notes on this in a little bit. But then, lastly, I'll also just note that there's a different way in which you the structures of these types of contracts when you get this type of money, right? That is to say, if you issue a loan or you take on debt or whatever, there's a time period until that limit expires where you have to pay that thing back or where that thing happens. In that time period, you are left untouched. You have capacity to do whatever you want. You're in control of your business. You can take small dips without them selling out or liquidating or short runs or pumps and pulls or whatever we want to call it. That means you just get capacity to actually exercise the type of company that you have. That short runs period where you can have small dips is really crucial because, as they say, the investor market isn't stable and there's going to be all these instances where things go up and down. So the capacity for you to have calmness and less stress in these issues or in these situations also mean that you're more likely to make good decisions when the decisions you're about to make are really, really critical. So I think in that instance we make significant advantages on them. But lastly, I think there's just a capacity for shareholders to always think that they know better because they have more money and have probably done similar things before. But it's unclear why that always translates into these instances. But I'll also note it's uncomparative because you could probably get sparring, you could probably get some sort of advice or whatever if that's what you wanted without having to trade off significant amounts of capacity to rule over your company. But also note the things that they can do are things like hostile takeovers, which another round told me will make me bad. I don't know, I thought that was funny to say. Then they tell us as a PY, but you can't sell these things. Note what deputy tells you. You can liquidate your shares if this goes bad. That's fucking ESL or EPL for the same thing we're saying. Obviously you can do these things. Saying there is no secondary market for this. It's just fucking words, man. That doesn't prove anything. Bullshit. No, thank you. If you can buy something, then obviously you can sell it. But even if it isn't true that I can just sell it without, someone allowing me to sell it, then I can force whoever actually gave me these shares in the first place to let me sell it because I have significant capacity to do this. So it's either I liquidate or you sell to someone who's worse than me because I don't want your fucking shares anymore because you're short-term dipping. And I think this is the type of case we bring on opening opposition. So if you want to talk about unresponded to, that's the case that's unresponded to in this instance, right? Let's talk about careful responses to opening government. Firstly, they say, shareholders don't like this, guys. That's bad. I agree shareholders don't like this because we take power away from them. But I think that's actually probably good on our side of the house. But I'll also note that they actually don't really prove why it is that shareholders are likely going to use their power for good innovation. More in the comparative in a little bit. The second impact that they try to claim is just there's less or fewer investments on our side of the house. But I don't think that's necessarily true because Darin does analysis on why it is that you increase negotiation capacity because you give more avenues for which you can negotiate on. That is to say, you can say, I'll take this deal or I will issue you debt instead, or I'll take a loan from you or whatever. But these are the types of concessions I'm willing to make. I'm not willing to make the other ones. So maybe you access different types of investor sentiments. So some are willing to give more things, some are willing to give other things, and that's nice for you to have that capacity to trade off between these things. But I'll also note if the equity investments that you're being proposed is really good, you can take it now, but you can also not take it because you have alternative ways of doing things. The alternative they want to propose to you is that banks exist, but I don't think that banks are likely going to fund startups because they don't have capacity to do this, but also they're inherently inherently famous for never doing these types of things. So I don't think that's necessarily true. Then they say, but you're going to have a larger amount of shares on our side of the house. But I also don't think that's likely given the analysis we already presented to you, because it's really likely that early funders restrict their capacity to issue shares to more people because they don't want more people to have the capacity to exercise power over your shares, right? So they limit the amount of people who have shares in these companies so that they're the ones who control this company in the first place. So even if you get more shares, you get them to the same kinds of people, also because you enter into these kinds of contracts with capacity to only issue more shares insofar that current shareholders shareholders approve that capacity for you to issue these shares. The responses we get, they say is like, the harm arises when this is a norm, so that people will opt into it poorly. But the comparative is also true, because if the norm doesn't exist, then there's fewer capacities for you to opt into anything in the first place, meaning you opt into worse deals on their side of the house for this exact reason. But secondly, you only buy shares if you want to make money. Why the fuck do you, like, it's comparative, right? So obviously if you want to make money and you think you'll make money from having shares, then you also think you'll make money from having debt, right? So because you already believe that this is going to be a somewhat profitable company. They say on their side of the house it's different, because you take long-term like types of deals, but you can just take long-term types of loans with less like risky payments on our side of the house, or smaller like net payments, whatever. So I think that's uncomparative in the first place. Closing.
Yeah, so even if there's a secondary market, after I sell you something, I have the money you've given me, so you can't threaten me to sell it again, because I have the money.
I don't understand. Like, your opening also says that you can do these types of things. Like, this doesn't make sense. But thirdly, they're going to make quicker reactions exactly for the reasons they give you themselves. They tell you, they follow you closely, they look at everything that you do, they're really attentive to the market. This means everything that goes wrong, they use it against you. They use it as reasons as to why they should come in and exercise control over your company. So comparatively, I think it's just significantly better, and we get significantly better types of investments on our side of the house. Then they say they won't actually start up because it's uncertain that they will make a profit. But then why would anyone buy equity if it's uncertain that they'll make a profit in the first place either? You're not buying equity in things that you don't think are profitable. Then they say they have more knowledge and they exercise this. But I already explained to you why that is a specific part that is incredibly stressful to these people, because they think that they're always going to come in and say what you need to do, what you should do. And they can't convince you with words. They force you to do it because they have actual ownership and capacity to force you to do things. I think there is a reason that startup founders are inherently successful and know their company best, because they're specialists within this type of field, because they believe in the innovation. And I think it's significantly better that you give power to the people who believe in the product and in the company than the people who benefit from short-run profits, pump and dumps, vote opening opposition.
Thank you, Deputy Leader of Opposition, for that excellent speech. Please call upon the Member of Government to begin back at the CG. Here. What do you mean?
It's fine.
Okay.
Hannah, ready? I'm assuming. Yes. Okay. Very simple case coming out of CG. Now those companies are much more likely to fail, and there is much more consolidation within those markets. Now, I just want to flag, top half, there is absolutely zero framing. What are the companies that are making this? In which time period are they making this? For what reason are they raising funding within late stage startups? And this is what I'll start with. When and why are late stage startups raising funding because of issuing bonds or equity on their side of the house? The first thing that I want to claim here is that most late stage startups don't need a final round of financing because of two main reasons. The first one is that they got the funding to create the company and to create the product. This was the A and B series funding. Most of the company is already operating because they're in late stage. That is the definition of late stage. And note that this funding they got mostly probably through VC, and they have already negotiated different phases of funding with this VC that are regardless on which side of the house you are within this debate. So they do have funding, they have created a company, and they have a created product. For companies that are doing well, that they have a product that they can sell and market, or they can create an IPO, it doesn't matter for them because they can get the money in other places. And secondly, and this is the other bit, is when you have a 1 billion evaluation, which is the evaluation that the CA team said that is late stage financing, know that you can A, start cashing in your product in order to finance yourself so you're not dependent on anybody else. So if you have a good product, then you probably start doing that. Or secondly, you just issue an IPO and then we're not having this debate in the first place. So it is not the very profitable, solid startups that are seeking funding or are seeking funding desperately, right? They can be seeking some funding, but it wouldn't be be crucial for their failure as a company. It is rather the companies that we are debating that are the most vulnerable within this debate are in late stages, but they can either not cash in their product because their product is not finalized, or secondly, they need more growth as a company in order to monetize. Those are companies such as Uber that just need multiple different markets for their product to operate in order for them to cash in. So those are startups that are in vital situations where they could fail if they do not receive the necessary funding in the best way possible. So this type of funding is crucial for them, whether they're going to go under or not, and they aren't making any money right now. If there is no funding, they're going under immediately. Why does that matter? And this is the second thing that Top Half did not interrogate at all. What are the actors that will debt finance you? Because there is this agreement, very weird agreement on the Top Half, that actually investors don't want to debt finance you. It is much better for them to get equity than to get debt financing, right? So what are the types of investors that are actually going to debt finance you if that's the agreement on the Top Half? It is not actors that actually want those companies to do good. It is rather actors that want those companies to go bankrupt, very namely the competitors of those companies. Why do they want to do that? Why is it a very good for your competitors or other actors with malicious incentives that want to break apart your company? Because in a moment that they own debt for your company, in a moment that this company now owes them something, when they go bankrupt, they are the first one to have access to the technology. And given that I have framed that those companies do not have any money because they're not making any money, the only asset that they have is the technology. So they directly have access to this technology in the first place. And that makes a lot of sense for their competitors because they can get the technology at face value and reintegrate it within their own company. This is a very easy incentive mechanism as to why those are the types of people that are actually going to buy this debt financing. From this motion, I have fiat to say that this is something that happens in very many startups because very many startups go for the debt financing. Yes, I'll take you.
This is completely symmetrical to equity. Microsoft owns half of OpenAI. They constantly invest in competitors to control them. There is no asymmetry.
The thing with equity is, and this is I want to make very clear, you choose who you sell your shares to. You do not choose who you're getting debt financing from. Why? Because the debt financing happens on the public market. When you issue a bond, it is on the public market. You need to disclose information, and everybody can buy the debt that you are making. This is how it works. Now, when does that matter? Two different situations in which this matters for the debate and why we are winning on them. The first one is it matters when companies might not fail if you have financed them enough in a different way, but you make them more likely to fail on your side of the house. Why? Because now companies, now the debt collectors have a couple of tools to make sure that you fail anyway so that they can get the technology that you're making. The first mechanism is you make it harder for them to diversify their funding with VC, because in a moment that you now have issued debt, less VCs also want to invest within you because you owe other people money, so they're not the primary investor. So it makes it harder for them to diversify the type of finances that they're getting, and so it means that you're probably getting less money than the amount that you need in order to stay afloat. But also secondly, and importantly, in a moment that you own debt within this company, you have this mechanism called recall. So you do have some involvement within the operations of this company because legally, given that you own them something, they can make sure that they pressure you within bankruptcy. But also thirdly and importantly, now you need to release public information about your books in order to make sure that the bonds. So the competitors have comparatively more information about those companies. They have comparatively more information about how they operate, and surely they are going to integrate it within their own company and make sure they outcompete them. So they might not fail on our side of the house, but on their side of the house they're more likely to fail, which means people get laid off. This is important technology that doesn't get developed all of the impacts that opening opposition wants to talk about. But the second situation in which we win is when those companies will fail anyways. We think that there is going to be more consolidation happening because they they now have direct access to the technology because they're the first ones to get paid off because they're the people that owe this debt. And this happens behind closed doors when antitrust cannot intervene because it is the law. They owe you this technology. And so very often when those bankruptcies happen and you're picking apart the company, antitrust cannot intervene given that you're already the primary owner of this company because of the debt. Why is this really bad? Very intuitively, those companies are awful. They collect your data, they browse guide you, they lobby government in order to be corrupt. They take more risk and make it more likely that we're entering another crisis for all of those reasons. CG.
Thank you, and we'll go to the excellent speech. Please push my competition.
Okie dokie. Everybody ready? Great. Extraneous points to prevent CG scams. 1. Why good startups still need funding. They needed to market their product to attract new customers so customers know what to buy and know the benefits of the product. Secondly, they needed to expand into new markets, meaning to pay regulatory fees to get approved, to push into new markets, to advertise to customers there. Thirdly, they needed to improve the quality of the product or lower down the production cost of the product so they can achieve larger margins on the product that they are selling. So even companies which are successful startups with a good marketable product can still and do actively need rounds of funding that they get on our side of the house through debt financing. Secondly, when Velina says, but equity you can choose and debt you can choose, this is pure Bulgarian lie. Nothing more. Why? Because private debt is private by the definition of the word private. It is not publicly traded debt. You did not make an IPO. What the fuck are you talking about? This is private debt that I'm giving privately to somebody and they cannot just go turn around and sell it. And second, say, but I can choose who buys my equity. No, you can't, because you have a board to decide who gets to buy equity. So if the offer is very high and Microsoft offers you a very good deal, you sell. Even though you're OpenAI, you're a direct competitor, but they make a very good deal, so the board makes you sell because they want the money that this is offered. So you cannot just purely say, we will always perfectly choose. We'll always perfectly choose who we sell. This is extraneous on CG. CEO, very basic case. We will prove why there is a hole in the market and why debt financing is most likely to fill this hole, something that equity can never do. Before I get into it, what's up?
So the normal CG frame changes nothing in our case. Harms of fewer startups protecting shareholders still apply.
Okay, thank you very much. CG, you want the POI to respond to that, or? Okay, good.
Peter.
Yeah, go for it. No, I'm joking. So, why is there a hole in the market? Look. 5 reasons for why holes in the market are formed and why they're very problematic. Firstly, there is many startups that have good products but low potential market size, meaning they can provide a valuable service to many consumers, but the number of consumers is limited in its amount. This does not mean they are not valuable. This just means they have low potential growth. Why are VCs uninterested in these companies? VCs invest in 20 companies, hoping that one of them will get 20x returns to make up for the losses that they expect to see on all the other ones. That means they over-prioritize things that have potential huge explosive growth and under-prioritize everything else. These are companies that never get funding but provide valuable solutions to very many people. Think of an app that lets blind people move around easily in the city. There's not that many blind people that would need this app, but this does not mean this is not an invaluable service that they could get if this startup got funding that could improve tangibly their life. This is also true for minorities. This is also true for localized solutions that affect only smaller countries which are not the US and whatnot, right? Secondly, improvement is not the companies that have improvements on current existing products but not necessarily brand new innovations, meaning we can do something that already kind of exists on the market but we can provide a new innovative take. These by definition have a smaller potential scalability because there's already a competitor on the market that has history over you. This does not mean they're not providing value to society by improving on existing products, but scalability is lower here and their potential market size is lower, therefore they're less likely to be able to attract equity, because equity again, what's potentially is very important about
about upscaling, right? Secondly, there's path dependency. Note that private equity and VCs invest in the same types of companies they have already invested in. Why? Because one, they have a higher risk potential, therefore they're more likely to want to be controlling of this company, want board seats, they will want the potentiality to know what this company is doing. Secondly, they go to range of things in the past, they're just the dot-com bubble, they know these things, they reinvest and overinvest into the tech bubble, but don't invest in solutions they're unfamiliar with. Thirdly, if they are going to be in the board, they want to be familiar with the subject matter. Fourthly, they could get consulted by the same 3 or 4 companies which are hyper-specialized in a very small number of things on the market, but do not branch out because this is harder and riskier. There's no reason to, right? Thirdly, regulation prevents many types of funding to ever get out into and try to fund. Things like pension funds do not invest like VCs because they have a risk potentiality they have to hedge against. Pension funds cannot go empty, otherwise people lose their pension, right? So they have to take safer investments. On our side of the house, debt is not limited by the amount of potential growth that a company can and is less risky. Why is it less risky? Because the debtors get paid first, definitionally, before equity does. Secondly, because it is secured by tangible underlying assets that you get if that does fail. And thirdly, because it's unreliant on rampant growth, meaning if a company 20x's or 5x's, you still get your 2% return on your initial investment, right? So you're unlikely to try to push these companies. Secondly, if you do have debtors, they hedge you against potential future debt, right? This is direct responsiveness to what CG says. They say, companies are risky, companies fall apart. Why? Think about it realistically and logically. Companies that give you debt, right? Debtors that try to invest in buying your debt and saying, okay, I will get some money back in an amount of time, 2.5% return on investors. They have a vested incentive to prevent you from over-debting yourself, because the more you over-debt yourself, the higher the chance that they have to pay out through securities, which they would prefer to avoid if at all possible. Meaning they incentivize you to not go over debt. They put clauses in to say, you're not allowed to make debt over a certain percentage of your total market valuation and whatnot, right? To that extent, they're more likely to prevent you to go into risky business practices. Compare this to equity. Equity does not give a shit if you fail, because they expect a certain percent of their investments to fail, which is fine as long as other investments they made, 20x or 30x or 50x and whatnot, right? Insofar, that means that equity is more likely to systemically create risky market practices and systemically create structural economic risks that affect not only those companies, but other companies reliant on those companies to succeed, right? What is the tangible impact of this? On our side of the house, you get debt incentivized to fill specific holes in the market, create tangible use for products for people who not have tangible specific products. This is why new products and innovation are relevant, and not as always says, innovation good, I guess, right? It means more smaller startups are created. It also means startups outside of the fucking US are created, right? Because note, in the status quo, VCs only invest in the West and in the US because highest potential market earnings, right? But also they have no competition there, right? As opposed to debtors who do not have to do this because they can go into smaller economies where their only potential competitions are banks who are there, and those banks do not have a lot of money and do not have very good deals, and therefore they can compete on this market, something that VCs do not do because there's much lower potential earnings there. And within the West and the US, VCs have no competition because tangibly and factually, I can't prove this, but this is a fact of the world, that banks do not give out currently in the West to private companies. So realistically, because banks cannot do this in the West, VCs do this in the West. But on our side of the house, debtors move in, they're able to access markets which are not the West and the US, creating an increase of economic wealth and an increase of products for everybody.
Thank you, member of opposition, for the excellent speech. Please open up to close up CG and the pledge. Cheer.
Closing opposition says there is a hole in the market. We say there is a hole in their case, mainly the previous sentence, that there is indeed a hole in their market. Look at the analysis they gave you. The analysis they gave you is that some VC firms don't do some things, that some pension funds don't do some things. They never explain why the profitability of venture capital means you don't make enough money from this to fill all of the relevant niches they have. Spending more money is not necessarily a good thing if this is not profitable, sustainable, and good for society. So I don't think just the max given to you before establish this claim. Let's just spot the ones which may or may not be relevant. First of all, they tell you that there are companies with low growth potential and VCs high risk seeking. Yes, but they're always considering, is this positive expected value, as in the probability of success versus probability of profit. So having lower probability of success, high probability of success with lower profit is still a good investment. The fact that you tolerate high risk does not mean you do the only high risk. So that's a silly reason. What's even sillier? That they want to be familiar with an industry. So maybe there are hyper-specific VC firms, but that doesn't mean there aren't hyper-specific firms in every industry, or that there aren't generalists which cover the industries hyper-specific ones can't do. They tell you pension funds can't invest. Yes, they can, but what they can do is take a small part of their money and put it in a venture capital firm, because usually VC gets the money of large pension funds, a small part of that portfolio. It's the same thing as private equity, because these safe investors are fine with 1 or 2% of their trillions going into something for potentially high returns. So you do get that money as well. Lastly, they tell you that venture capitalists don't care if you fail because they're high risk. Guys, this is silly. They accept a risk when it is tolerable for return. They do not accept stupid risk when it is intolerable for no return. That is just silly. Then the response they tell you is that good startups still need money. And they gave you reasons, but not, which is in response to our extension, but not all of the reasons they gave you are related to expansion and how fast you adopt the market. What Velina told you is that these startups would probably eventually be fine. Yes, maybe they delay disrupting the market by a bit, but in doing so, they risk going under in their entirety or being consolidated and bought up. Second, I tell you this is private debt. If I am the only person in this room who can speak English, I will go out screaming. Issuing debt does not mean getting a loan. I do not issue debt when I get a loan for a house. Issuing debt, like governments issuing debt, means you issue it publicly. You're the one who is selling this to someone else. This is just not the debate. Go fight Amitai afterwards. I guarantee you that is what he meant. I know you beef with Amitai a lot. Pity he's not judging here.
Only we're done.
Lastly, the board will make you sell to Microsoft. Yes, but they will only make you sell to Microsoft if Microsoft offers you a much better deal than you are worth. Than you are worth. If the market is good and this VC is good, they won't do this. So that's CO. Next, what I'll do, I'll engage with the two claims from opening opposition. Both of them will either be completely neutralized or flipped. So at the end of this, it's an independent reason why we should be beating this. You don't need Velina's speech to buy this. First of all, O says you take out too much debt. Now, opening government here identifies that issuing debt means there's less information for this. Here's why I think the reverse is true. Sometimes you have very strong and pernicious incentive as a company to issue debt because you don't care about what happens to that, and that is problematic. Why? Because oftentimes there are situations where a VC fund, where a company is likely to go under or has very high chance of going under. But the people who work there have either two problematic incentives. First of all, they're irrational. They were founders, they're very emotionally attached to the thing. They think it can be the next great thing for humanity, which is why they discount the likely risk of this thing, which is why they can ask for debt even if it's not viable. Second, they can just be selfish. I'm a tech bro, I'm making fat stacks here. I don't care if the company goes under in 2 years or 1 year and we waste some investors' money if we can get away with it. I'm gonna get my bands and the company's going out anyways. What is the problem? When you issue it publicly, you do not disclose everything. You don't disclose all of your financials. You do not disclose your tech. You can lie about your tech in the public markets because that is public. That is information you don't want to disclose to your competitors, which means there's much less of a screening mechanism. VC looks at everything. They have the specific expertise and the trust. There's a legal trust. Once you disclose to a VC fund, they cannot tell your competitors, which is why the VC funds are much better at assessing the situations wherein the investors, the company is asking for money when it knows it's going to be wasted. And also they have the specific expertise in a way a bank or other creditor doesn't necessarily have. The implication of this is simple. I have just explained why there's a subset of cases where debt is borrowed irrationally and this is money being wasted. You should dislike this because money being wasted is bad. That is money which could be saved in someone's pension or invested in some other better company. Second, I tell you venture capitalists are going to be abusive. Okay. First of all, on incentive, because we're still a Balkan team. First of all, they have no exit strategy. I'm sorry, this is true. Even if this is a lie, the manual, even if it's a knife of OG, the manual says you can knife OG if they have an egregious lie. It is an egregious lie that there's a secondary market for venture capital. This is just not true. Second, as I explained in the POI, there is no threatening mechanism of selling their stock because the stock is not publicly traded. You can sell the stock you bought from them. You still give them the money. This is not a way you can threaten them. I don't understand what you get from that. Second, you don't have an incentive to disadvantage them to like help your other portfolio because 98% of your portfolio is going to go under. So you can't really pick winners and losers because you don't know who's going to be the winner or the loser, even if you don't accept this. So the implication is that you want the long-term benefit of your companies, which means you're going to give them connections, you're going to give them advice on people to hire, things which Laura dismisses but are actually quite important. Second, on capacity. You can't do a hostile takeover of a private company. Hostile takeovers only work when you can buy stocks. These are not stocks, this is pre-IPO. Silly, you can't do this. Second, you delegate, you can, this also second, it's a fairly competitive market. It's fairly easy to enter VC because you don't need that much money to be in VC. The like size of a portfolio of most VC is in the low billions, which means your reputation really matters. POI.
Be for real, your claim is that billion-dollar companies are so poor that they issue bonds that harm themselves. This is not a goal you meet.
So, not having a billion doesn't mean you have 999 million. This is a range, and we extend you that the most relevant cases are the ones Velina talks to you about. I'm sorry, if it's a company with sound financials, they can dilute their equity and still do IPO or get debt. This is not the relevant context of this debate. Lastly, given that this is a competitive market, there's a strong reputational damage of like being an abusive VC fund, which is why you would never want to do this. This means O does not have a case at the end of my speech. How do we then explain over opening government? They have a couple of gaps. The first one, which we fix, is that we establish why this is done in situations where the market is making a mistake. They never explain why this is being done in situations where it makes sense, transfers over to the shitty ones. They say it becomes the norm, but why is the market unable to see that there's a difference between a big company and a small shitty one? Is the market stupid? They don't explain this. Second of all, they don't explain why even if this is a risky decision to take on debt, they are still likely to do this in a way which harms them and deters entry. It is my unique mechanism in the third minute of my speech which explains why there's a substantial risk of situations like this. Second, we show you a bigger impact on consolidation because of Velina's mechanism and the other stuff I told you about. Yes.
Thank you for that excellent speech. Can I call upon to it?
It's very dark now here. Originally, I was going to be nice to closing. I don't want to be sleeping on the couch or nothing like this. But let's be totally real. He started hostile, so we have to escalate this. Otherwise, we're fucking pussies. I can tell this guy's never worked a finance job a day in his life. He's read this shit from textbooks, don't know nothing about the real world. Firstly, responses to the thing closing government whip gives us. The first thing they say is, oh, but the market fills these holes. And the mechanism is, there is very much money, so eventually some money is gonna go to this. 3 reasons why it never goes. The first is, it's very important. What do VCs want? Do VCs want to make money? Well, no. VCs want to raise money. They want to get new funds to make more fees on managing those funds. Here's a very important thing. You look like a fucking moron if you diverge from the common wisdom of the market and you are wrong. You will never raise a fund again because investors trusted you and you did some stupid shit. So VCs constantly do the same thing that is expected in the market. They invest in the same kinds of companies because there's a very clear, obvious flaw with the kind of thing that happens in this particular case. That's why it's a massive problem. Also, secondly, and here's what they say, they do it on a positive expected value way. As if VCs have the machine where you put in the startup and it says it's positive value, it's negative value. There are 10 billion unknowable risks when investing in a startup. Shit can go wrong. The fucking founder could get a heart attack tomorrow. He can take the money and go to Bali in this kind of capacity. No, these are all real things. So you need sufficient makeup to take this kind of risk. The company being able to 20x or 30x. Why is this different for debt? Because importantly, debtors have other ways of making up risk. Debtors can have collateral, which is actual physical assets, which often equity people are the last to get
in the case of a liquidation, but also debtors can have, like, debtors get paid first and they get paid smaller amounts regularly in this particular case, so they care comparatively less. But thirdly, and this is very crucial, they say, some mega specialized VCs only invest in the companies they know, but not all of them in this kind of sense. But yes, they do. Why? Because you become a board member if you're an equity investor. And if you think you invest in a company that you do not understand, not only can you not be good for the company, you think you can be actively bad for the company. You think you can give it bad advice, that you can sabotage it to the point where you don't understand it. Debtors don't sit on your board. They don't give a fuck, right? They invest in anything that has good numbers, even if it's not the specialty that they do, but also necessarily because they take comparatively less risk. But also secondly, they say, big pension funds will always invest with a percentage of the money that they have. The first is, this is even arguably true if this happens in real life. Many pension funds from a regulatory perspective are not allowed to do this, but they would be allowed that. But also the second bit is, there's a very obvious response. Yes, they would just now do it more, right? Instead of 2%, they would invest 4% or 5% or 6%. Why is it more likely that these risk-averse investors will do this? Well, because debt is vastly less risky than equity. So it's far more likely that it's within their risk parameters than equities. This is a good thing. Like, it's better to invest in startups than in the stock market. And if we can allow the biggest institutional investors to enter the startup market and get long exposure, this is obviously a great thing at the point where we want to claim this. Secondly, they say, at best our case proves these people, we delay the effect of startups, not that we stop it. The first response to this is, well, even if we delay it only, this still has a massive effect. Even if startups are slowed down, the kind of startups we talk about, from affecting people positively, even if only for a time, this is a large effect comparatively. But also secondly, very often we do stop them. Why? Because they say, your product still exists, it's around, but you aren't the only company in this market. So very often you're competing with existing shitty solutions that notice have more of a buy-in from people, that have more access to bank funding potentially and stuff like that, with more regulatory support. So you need extra money to fight them, extra money for like apps that make schools in developing countries to get a fucking market share, shit that would never get funded on the other side comparatively. But finally, responding to their argument, the first thing they say is, definitions, guys, let's debate definitions, because issuing debt necessarily means it's public debt. Dude, you can issue private debt. You can issue a bond which is only sold to an individual person and they do not have the right to sell it otherwise. You can issue equity that is only private. Equity doesn't mean a publicly traded fucking stock. Like, I don't know how you should adjudicate this, but this is so obviously factually true that I don't even know how you would claim that it isn't. Most of these deals are private. Why are they private? Mechanistically. Because the stock market has heavy regulations on the kind of companies that can trade their debt and equity there. Startups often do not meet those heavy regulations. Ergo, the vast majority is private. So their mechanism is, you can't choose who you give debt to. Of course you can. You choose who to make the deal with in this kind of sense. But also secondly, you can do this with equity as well. Their only reason is, but you know, equity, how you say, it can only happen if it's a much better deal. Microsoft can buy your equity. It doesn't have to be that much better. It just has to be good enough for your board to invest. Your board doesn't care about your product often. They don't care about anything like this. All they care about is making money. So if Microsoft gives you enough money, then Microsoft will be able to get on your board because your board doesn't care about any of the external impacts that they care about. Like, Microsoft is also willing to pay for the fair market price value of your debt, even if their mechanism is true. So why wouldn't they be willing to pay the fair market value of your equity, even potentially with a slightly more money? I literally don't understand how this one mechanism in their case is asymmetrical. But also, like, what is their mechanism? Well, some competing companies can access this kind of thing. Well, maybe it's a good thing for them to access it. Maybe they can scale it comparatively better. Maybe they can do any of these kinds of things. Like, why is this necessarily such a good thing? Yes?
If companies have high growth potential, PE and VCs come up with your extension and the share price rises. If they have low growth potential, they must issue risky bonds with high interest, and the startups aren't founded, so you can't buy their debt even if you
No.
This extension is
there are startups that aren't all that risky at the Series C and D stage that make relatively consistent money, just have a limitation on how much this money can grow. A VC needs their money to grow, a corrector does not need their money to grow. Simple DeepL extension. Engaging on everything else in the debate, which is like, are these investors good, are these investors bad? So I'm
going to add in closing opposition with, mind you, a piece of spec which destroys a large part of this was, investors really like controlling the company and it's a good thing. It's very bad if investors control the company. Debtors can also kind of control the company. There's a thing called debt covenants where they can limit many of the things that a company can do as a condition of taking on that debt. They aren't functionally that different in terms of this particular thing. We tell it's about the amount of money, not necessarily what they do with this particular money. Also, secondly, this is just so clearly non-mutually exclusive. Like a startup, if the choice between taking on debt and taking equity, will take both because it's a race to the bottom. If you don't do it, someone else will. So you constantly need to be competing for more marketing, for more shit like this. Also, thirdly, this is true for AI startups. I don't care if AI startup 279 fails. I care if one startup that are actually important that wouldn't get funding succeed. Vastly more important case. Vote us!
Thank you, opposition, for the excellent speech. Thanks to everyone for a great debate. Get out of here.